The world of trading and investing has seen countless figures rise and fall, but few have left a legacy as profound and enduring as Jesse Livermore. His journey from a boy plunger to one of the most successful traders in Wall Street history is a testament to timeless principles that continue to shape modern trading practices. Livermore's insights, meticulously captured in Reminiscences of a Stock Operator, provide a masterclass in market speculation, with his system of pivotal points standing as a cornerstone of his extraordinary success. Understanding these pivotal points is not merely an academic exercise. It is a practical pathway to identifying and capitalizing on the significant market trends that define fortunes. A pivotal point, as conceived by Livermore, is a critical price level where a stock, after reaching a certain valuation, struggles to move beyond it or fall below it, only to eventually break through. This breakthrough then signals a potential for a substantial sustained movement or a definitive shift in the prevailing trend. It is at these precise junctures that a discerning trader finds the optimal moment to enter or exit a market position, significantly enhancing their probability of success. The concept demands not just keen observation, but immense patience, for the market rarely reveals its intentions prematurely. The art lies in waiting for the market itself to confirm a particular direction, allowing the price action to tell its story before committing capital. This patient, precise timing is paramount, distinguishing speculative success from mere gambling. Livermore understood that rushing into a trade based on intuition alone was a recipe for disaster. Instead, he advocated for a methodical approach, waiting for the market to align with his analysis, ensuring that when he acted, it was with conviction born of confirmation. The pivotal point is not a magic number, but a dynamic area where supply and demand are in delicate balance, and its eventual breach signifies a decisive victory for one side, setting the stage for a new phase of price discovery. This systematic approach eliminated much of the guesswork, allowing him to operate with a clarity that eluded many of his contemporaries. Identifying these pivotal points requires a sophisticated understanding of market mechanics, focusing on several key indicators. Central to Livermore's methodology was an unwavering reliance on pure price action. He viewed the raw movement of prices as the most honest and direct indicator of market sentiment, stripping away all noise and focusing on the underlying battle between buyers and sellers. He meticulously studied charts, not for complex patterns, but for the inherent logic in how prices behaved around certain levels. A stock's inability to break a certain high after multiple attempts, followed by a sudden, decisive move past that level, was a classic pivotal point setup. This required a deep intuition for how the market felt, an intuition honed over decades of intense observation and countless trades. He looked for clear, discernible patterns in the way prices moved, rejecting anything that seemed ambiguous or overly complex. The simplicity of his approach to price action was its strength, allowing him to cut through the extraneous information that often clouded other traders' judgments. Complementing price action, Livermore placed critical importance on analyzing trading volumes. Volume is the fuel that drives price movements. A significant price increase accompanied by robust volume indicates strong buying conviction, solidifying a bullish trend. Conversely, if prices rise on diminishing volume, it often signals underlying weakness, suggesting that the upward move lacks conviction and may soon falter. When a stock approaches a potential pivotal point, an increase in volume as it tests or breaks that level provides crucial confirmation. A breakout on low volume is often a false signal, a trap for the unwary. Livermore understood that without the backing of substantial trading activity, price movements were often unsustainable. A true breakout, a genuine pivotal point being crossed, would be accompanied by an unmistakable surge in volume, signifying broad market participation and commitment to the new direction. This interplay between price and volume was a constant theme in his analysis, providing a dual confirmation mechanism that greatly reduced the incidence of false signals. One of Livermore's signature strategies involved capitalizing on breakouts that occurred after prolonged periods of market consolidation. Consolidation phases are periods of relative calm, where a stock's price trades within a narrow range, indicating a temporary equilibrium between buyers and sellers. These periods are often precursors to significant moves, as pressure builds within the confined trading range. When the price finally breaks out of this consolidation, either to the upside or downside, it signifies a decisive shift in sentiment and the beginning of a new trend. Such breakouts, especially when accompanied by increasing volume, were considered prime pivotal points for Livermore. He patiently waited for these periods of quiet accumulation or distribution to resolve, knowing that the ensuing move would often be substantial. He did not attempt to predict the direction during consolidation, but waited for the market to declare its intent, entering only after the breakout was confirmed. This patient observation of consolidation patterns was a hallmark of his disciplined approach, preventing premature entries and ensuring he was positioned for the most powerful moves. Furthermore, the achievement of new price highs or lows served as potent pivotal points for Livermore. A stock reaching a new all-time high was not a signal to sell out of fear, but often a robust signal for further buying. It indicated that the stock had overcome all previous resistance, entering uncharted territory where there were no overhead sellers to impede its ascent. Similarly, a stock plummeting to a new all-time low was a strong signal for short selling, as it indicated a complete collapse of support and a potential for further declines. These new extremes represented psychological thresholds where the market's collective conviction was either overwhelmingly bullish or bearish. Livermore understood that these were not random occurrences but definitive statements from the market about a stock's underlying strength or weakness. He was not afraid to buy into strength or sell into weakness, recognizing that the market often rewards those who follow its lead rather than fight it. These new highs and lows were not merely data points. They were declarations of market intent, powerful signals that demanded attention and decisive action. Underlying all these specific identification methods was Livermore's profound understanding of market cycles and trends. He firmly believed that prices move in trends, and his focus was always on capturing the large, sustained movements rather than getting entangled in the minor, day-to-day fluctuations. The pivotal point system was precisely designed to help him identify these significant market shifts at their nascent stages, allowing him to position himself early in a trend and ride it for its full duration. He recognized that attempting to profit from every small wiggle was futile and ultimately unprofitable. His strategy was about patience, waiting for the big fish, and then holding on with conviction. He understood that the market's true profits lay in its major movements, and the pivotal points were his key to unlocking these opportunities. This macro perspective, combined with his micro-level analysis of price and volume, created a robust framework for long-term speculative success. He was a trend follower in the purest sense, using pivotal points as his entry and exit signals for these overarching market narratives. Once a potential pivotal point has been identified, the subsequent actions are as crucial as the identification itself. Livermore emphasized the imperative of entering a trade only after the market unequivocally confirms one's analysis. This means waiting for clear price action and volume confirmation, avoiding the temptation to anticipate a move. Premature entry, based on an unconfirmed hunch, was a common pitfall he rigorously avoided. He would rather miss the first few points of a move than enter too early and face a reversal. The market, in his view, always provided sufficient confirmation for those patient enough to wait. This confirmation was not a subtle hint but a clear declaration, often in the form of a decisive breakout on heavy volume. He sought undeniable evidence, a robust signal that left little room for doubt. This principle of confirmation protected him from numerous false starts and allowed him to commit capital with greater confidence. When the market does provide this confirmation, Livermore advocated for entering the trade as early as possible after the signal. This is not a contradiction to waiting for confirmation, but rather a distinction between anticipation and swift action once the signal is clear. Once the pivotal point is definitively breached and confirmed, delay can erode potential profits. The initial thrust after a breakout is often the most powerful, and capturing that momentum is key. This required decisive action and the courage to act on conviction. Hesitation, once the market had spoken, was as detrimental as premature action. He believed in striking while the iron was hot, capitalizing on the initial energy of a new trend. This early entry, post-confirmation, allowed him to secure a favorable position before the broader market fully recognized the shift, maximizing his potential gains as the trend matured. Risk management was a non-negotiable cornerstone of Livermore's trading philosophy. He famously stated that the paramount rule was to cut losses quickly and allow profits to run. This meant having a predefined stop-loss point for every trade, exiting immediately if the market moved against his position beyond that threshold. He viewed losses as tuition fees, an unavoidable cost of doing business, but insisted they be small and controlled. Crucially, he vehemently opposed the practice of averaging down on losing positions. Adding to a losing trade, in his view, was akin to throwing good money after bad, a desperate act that inevitably led to larger, more catastrophic losses. He understood that a losing trade was a signal that his initial analysis was incorrect, and the only logical response was to exit and reevaluate. This disciplined approach to capital preservation was fundamental to his long-term survival and prosperity in the volatile markets. It was a stark reminder that protecting capital was always the first priority, even above seeking profit. Discipline and patience were not just virtues for Livermore, they were the bedrock of his entire trading system. He often observed that many traders failed not because of a lack of intelligence or skill, but due to their inability to control their emotions and adhere to their own rules. The market, he believed, was designed to exploit human weaknesses: fear, greed, and impatience. Success required the mental fortitude to resist these urges, to wait for the perfect setup, and to execute trades without emotional interference. This unwavering discipline allowed him to sit idle for weeks or months if necessary, waiting for a clear, pivotal point to emerge, rather than forcing trades out of boredom or a desire for action. His patience was legendary, a testament to his understanding that the biggest profits came from waiting for the clearest opportunities, not from constant activity. He cultivated a mindset where he was content to do nothing until the market presented an undeniable opportunity. A fascinating aspect of Livermore's observation was the concept of a normal reaction after a breakout. After a stock breaks through a pivotal point and begins its move, it often experiences a temporary shallow pullback or consolidation. This normal reaction is characterized by lower trading volume, indicating that the initial momentum is momentarily pausing, but there is no significant selling pressure. Livermore saw this as a healthy sign, a natural breathing spell before the trend resumes with renewed vigor and increased volume. It was a test of conviction for many traders. The impatient would often exit during this pullback, only to watch the trend continue without them. He understood that not every minor dip was a reversal signal. Many were simply pauses, allowing the market to consolidate gains before the next leg up. Recognizing this normal reaction allowed him to hold through minor fluctuations, confident that the underlying trend remained intact and often presented an opportunity for those who missed the initial breakout to enter the trade. The lessons of the market are powerful, but they are often paid for with devastating losses. Jesse Livermore himself paid millions of dollars for his education, with each failure adding a new, invaluable rule to his trading arsenal. Fortunately, you do not have to pay the same steep price. The most effective way to accelerate your learning curve is to study the mistakes and successes of the masters. Edwin Lefebvre's classic Reminiscences of a Stock Operator is the ultimate case study in a speculator's career. It chronicles not just the legendary wins, but the brutal losses and the critical lessons learned from them. To extract every ounce of practical wisdom from this story, the detailed chapter-by-chapter analysis by Max Davidson is an indispensable tool. It transforms Livermore's life into a personal trading manual, breaking down each event to show you exactly what to do and what not to do in today's markets. To learn from Livermore's mistakes instead of your own, find the link to this invaluable resource in the description below. Beyond the technical aspects of identifying and acting on pivotal points, Livermore deeply understood the profound influence of psychology on trading success. He recognized that the market was not merely a collection of numbers, but a reflection of human emotions, particularly fear, greed, and the potent force of the herd instinct. These emotions, if unchecked, could derail even the most meticulously planned strategies. Traders often become overly optimistic during bull markets, leading to reckless speculation, and overly pessimistic during bear markets, leading to panic selling at the worst possible times. Livermore himself was not immune to these psychological pitfalls, but through painful experience, he learned to identify and mitigate their impact. He understood that the collective psychology of the crowd often led to irrational behavior, creating opportunities for those who could maintain a detached, objective perspective. His solution was an unwavering commitment to discipline and objectivity. He believed that successful trading demanded a rigorous control over one's emotions, refusing to allow personal hopes or fears to dictate trading decisions. The market, in his words, never lies, while opinions often lie. This profound statement encapsulates his philosophy. Trust the market's signals, its price action, and its volume, rather than one's own biases, predictions, or emotional impulses. He learned to detach himself from the outcome of individual trades, focusing instead on the execution of his system. This emotional detachment allowed him to cut losses without hesitation and let profits run without the fear of giving back gains. He cultivated a mindset that prioritized the objective reality of the market over any subjective feeling or desire. Livermore also warned against the common pitfall of not sitting still. Many traders, driven by impatience or the thrill of constant action, feel compelled to be in the market at all times, even when there are no clear signals. This tendency to overtrade, to force positions where none exist, often leads to unnecessary losses. He understood that significant profits came from waiting for the clearest, most undeniable setups, not from constant activity. The market often moves in cycles of clear trends and periods of indecision. During periods of indecision, the most profitable action is often no action at all. His discipline allowed him to remain on the sidelines, preserving capital until a true pivotal point emerged. This patience was not passive. It was an active decision to wait for the highest probability setups, understanding that capital was best deployed only when the odds were significantly in his favor. He valued capital preservation above all else, knowing that only by protecting his capital could he remain in the game to capitalize on the next big trend. To further refine his psychological and analytical edge, Livermore was a meticulous record keeper. He maintained a detailed trading journal, not just to track his trades, but to reflect on his thought process, his emotional state during trades, and the reasons behind his decisions. This systematic introspection allowed him to identify recurring patterns in his own behavior, understand his biases, and learn from both his successes and his failures. The journal was a tool for self-correction, a private mentor that helped him to continuously improve his discipline and objectivity. By documenting his expectations, his entries, his exits, and his emotional responses, he built a comprehensive database of his own trading psychology, allowing him to evolve as a speculator. This practice, though seemingly simple, was a powerful mechanism for turning raw experience into actionable wisdom, making his learning curve steeper and his insights deeper. Despite the profound technological transformations that have reshaped financial markets, the core principles of Jesse Livermore's pivotal point system remain remarkably relevant in modern trading. While high-frequency trading algorithms and complex derivatives now dominate significant portions of the market, the fundamental drivers of price movement, human psychology, supply and demand, and the tendency of prices to trend have not changed. Livermore's methods provide a timeless framework for identifying major trends and filtering out the pervasive noise that can overwhelm contemporary traders. In an era saturated with information, his emphasis on clear price action and confirming volume helps cut through the distractions and focus on what truly matters. The tools may have evolved from paper charts to sophisticated software, but the underlying logic of identifying key levels and waiting for decisive breaks remains as powerful as ever. His approach encourages an analytical mindset, one that is rigorously backed by market data, rather than speculative forecasts or fleeting rumors. He would not have been swayed by social media hype or unverified tips. Instead, he would have meticulously observed the price and volume around critical levels, waiting for the market itself to confirm a narrative. This data-driven discipline is more crucial today than ever, providing a necessary counterpoint to the emotional exuberance or panic that can quickly spread through digital channels. The principles of patience, discipline, and objective analysis are universal, transcending specific market conditions or technological advancements. He taught that one must always be a student of the market, letting the market dictate the terms, rather than imposing one's own will upon it. One of Livermore's most enduring observations: there is nothing new on Wall Street. What has happened in the stock market today has happened before and will happen again, perfectly encapsulates the enduring relevance of his system. Market cycles repeat because human nature, with its inherent fears and greed, remains constant. The pivotal point system, by focusing on these universal patterns of price behavior, offers a framework that is immune to the transient fads and innovations of the financial world. It is a system built on the unchanging truths of market dynamics, making it as applicable to cryptocurrency trading or forex as it was to the stock market of the early 20th century. By understanding these cyclical patterns and applying the disciplined identification of pivotal points, modern traders can position themselves to ride the next big wave, just as Livermore did. He taught that true success in speculation came from recognizing these enduring patterns and acting upon them with conviction and discipline. The best way to shorten your learning curve in speculation is to learn directly from the masters. The lessons of history, the memoirs of those who have navigated the treacherous waters of Wall Street and emerged with fortunes intact, are an invaluable education. To this end, a new channel, Wall Street Memoirs, has been created to serve as a library of this essential wisdom. This is not a channel for hot tips or fleeting market gossip. It is a repository of the timeless strategies, the hard-won philosophies, and the personal recollections of the legends who shaped the financial world. By studying their campaigns, their successes, and, just as importantly, their failures, you begin to understand the business of speculation at its highest level. You learn how they managed capital, how they analyzed conditions, and how they cultivated the discipline to act like true professionals. For anyone committed to learning from the best, Wall Street Memoirs is an essential resource. The link is in the description. In summary, Jesse Livermore's pivotal point system is far more than a simple trading tactic. It is a holistic philosophy for engaging with the markets. It is a testament to the power of observation, patience, and unwavering discipline. By focusing on critical price levels confirmed by volume and understanding the psychological undercurrents of the market, traders can learn to identify and capitalize on significant market movements before they become obvious to the masses. Livermore's legacy teaches us that true success in speculation comes not from predicting the future, but from reacting intelligently and dispassionately to the market's clear signals. His principles of cutting losses quickly, letting profits run, and waiting patiently for the highest probability setups remain as vital today as they were a century ago. Embracing this system requires a commitment to continuous learning, a rigorous adherence to personal rules, and the mental fortitude to adapt to the market's ever-changing landscape, just as Livermore himself did throughout his legendary career. The market always offers opportunities for those who are prepared, disciplined, and patient enough to recognize its pivotal moments. They force trades, and the market punishes them for their impatience. You can't force profits out of a market that's not ready. You can only position yourself so that when it is ready, You're calm, clear, and confident enough to act. That's what precision really means, readiness. It's not about guessing the next move. It's about being perfectly prepared for it when the signal comes. It's like hunting. You don't chase the animal through the woods. You wait quietly until it comes into range. The shot you don't take is often the one that saves your ammunition for the opportunity that matters. Now, trading less also means studying more. The fewer positions you take, the more time you have to analyze each one properly. You start noticing the fine details, how a stock behaves before breaking out, how volume builds quietly before a move, how price reacts to key levels. Precision is born out of observation. You can't see those details when you're constantly in and out of trades. You're too distracted, too emotional, too reactive. You remember what I said in that earlier talk on the rule that prevents losses, that your first job is to protect your capital. Well, trading less is another form of protection. Every trade you avoid that doesn't fit your criteria is a trade that saves you money. The best traders don't just manage risk when they're in a position, they manage it before they even enter one. They understand that doing nothing is often the most profitable decision they can make. Do you know what overtrading really signals? A lack of conviction. When you're uncertain about your edge, you compensate by taking more trades, hoping that the law of averages will bail you out. But that's not trading. That's gambling with better lighting. Precision means you wait until the odds line up in your favor, when price, volume, and market tone all speak the same language. That's when you act decisively. You don't hesitate. You don't doubt. You move with conviction because you earned that conviction through patience. The beauty of trading less is that it sharpens your emotions. You stop being numb to losses. Every trade matters again. When every trade carries weight, you treat it with care. You plan it. You set your risk, define your exit, and monitor it with attention. That kind of focus is what separates real traders from the crowd. Most people lose not because they lack knowledge, but because they spread themselves too thin, too many trades, too many distractions, too little control. Ask yourself this: what if you took only 5 trades this month, but each one was chosen with surgical precision? You'd watch the market differently. You'd study every angle, test your reasoning, and wait for the market to confirm your idea. Your win rate might not jump overnight, but your consistency would. And consistency is what makes wealth in trading. It's not the one big win. It's the repeated execution of a sound process. There's another hidden advantage to trading less: emotional endurance. Every trade you take drains a little bit of your focus, a little bit of your mental energy. Too many trades, and you start trading on fumes. That's when mistakes multiply: missed stops, impulsive entries, poor position sizing. Precision trading keeps you mentally fresh. You're not reacting to every tick. You're observing, thinking, and waiting. That kind of composure can only come when you're selective. And the irony is, the less you trade, the more you tend to make. Because when you wait for only the cleanest setups, your trades align better with the market's natural rhythm. You enter with the trend instead of against it. You exit with discipline instead of emotion. You stop fighting the market, and you start moving with it. That's precision, the harmony between your actions and the market's intention. Trading less also helps you see the bigger picture. You stop obsessing over every tick and start thinking in terms of waves, cycles, and probabilities. You stop being a day-to-day speculator and start becoming a strategist. And when you view the market from that height, the noise fades. You're no longer chasing opportunities, you're letting them come to you. The market rewards patience because it punishes impatience. Every great trader I've ever known had one thing in common: they knew when not to trade. They could sit in cash for days, even weeks, without feeling the itch. That's because they understood that their real edge wasn't in predicting the next move. It was in waiting for the right moment to act with total precision. Trading less, then, isn't about doing nothing. It's about doing the right thing at the right time. It's about quality over quantity, conviction over noise, and clarity over activity. Missing a move is cheaper than forcing a bad trade. Every trader knows that pain, watching a stock take off without you, climbing point after point while you sit on the sidelines. You feel that pull in your chest, that whisper that says, "I knew it was going to move. I should have just gotten in." But that whisper is the market's most dangerous voice. It tempts you to chase, to act after the move has already begun, to trade not because of a setup but because of emotion. That kind of thinking has emptied more accounts than bad analysis ever has. I've missed plenty of moves in my life. Some were big, the kind that make headlines. But I learned early that missing a move never ruined me, taking the wrong one did. The market is full of opportunities. There's always another setup, another signal, another chance. But there's only one capital base, and once it's gone, the game's over. The cost of regret is temporary. The cost of a bad trade can last a lifetime. Let me ask you something. How many times have you jumped into a stock just because it started running and you didn't want to miss out? You probably told yourself, "It's already moving, I'll just grab a piece of it." And what happens next? The moment you buy, it pulls back. You watch your entry go red, and suddenly you're hoping instead of trading. You start telling yourself you'll hold until it bounces, but the bounce never comes. That's not a trade, that's a trap. The professional trader doesn't fear missing out. He fears losing control. He understands that trading is about waiting for confirmation, not reacting to movement. Prices move every day, that's their job. But the market only offers a few real opportunities where the odds are in your favor. If you miss one, it doesn't matter. There will always be another one. The only thing you lose is the illusion that you needed that trade. When you force a bad trade, you're not just risking money, you're damaging your discipline. You're telling yourself that your rules don't matter, that emotion gets to call the shots. And once you cross that line, it gets easier to do it again. One emotional trade leads to another. Before you know it, you're no longer trading a plan, you're trading your frustration. The market doesn't need to beat you at that point. You've already beaten yourself. There's an old truth I've seen play out countless times. The trades you miss won't hurt you nearly as much as the trades you shouldn't have taken. Missing a trade is an opportunity deferred. Taking a bad one is capital destroyed. And in this game, capital is time, it's your future buying power, your ability to stay in the game long enough to win. Once you understand that, you start valuing patience over participation. You remember in the earlier video, we talked about the rule that prevents losses. That rule was your shield. It kept you from bleeding capital when emotions ran high. This principle builds directly on that. Missing a move is an act of protection. It's your way of keeping that shield up. It's saying, "I'll pass on this one because my edge isn't clear." That's not weakness, that's strength. Every professional trader lives by that code. Do you know what separates a trader from a gambler? The trader waits for alignment between price action, volume, and market context. The gambler acts on impulse. The trader might miss 10 moves before taking one, but when he takes it, he's positioned with confidence. The gambler takes 10 trades and hopes one works. That's the difference between consistency and chaos. Missing a move teaches you patience, but forcing a bad trade teaches you pain. And pain leaves marks, emotional marks that linger long after the loss is gone. You start hesitating on good setups because the last impulsive one burned you. You start second-guessing your own strategy. That's how overtrading begins, trying to make up for what never should have been lost. The truth is, no one ever went broke sitting on the sidelines. You can't lose money by waiting. The hardest part is accepting that waiting is still part of the job. The market doesn't care that you're bored or that you missed the move. It doesn't reward neediness. It rewards precision and patience. When you learn to be okay with missing out, you start trading from strength, not from fear. Let me ask you again, which costs you more, missing a move or forcing one? Most traders know the answer, but they don't live it. They'd rather be in something, even if it's wrong, because they can't stand the feeling of watching a chart run without them. That's not trading logic, that's ego. The market has no room for ego. It will strip it from you one loss at a time until you either learn humility or quit. Every time I waited for the market to come to me, I made money. Every time I chased a move, I paid tuition to the market. That tuition isn't just dollars, it's time, energy, and confidence. But the more you chase, the more the market teaches you the same lesson patience pays. Impulsiveness costs. You can't force profits out of timing that's already passed. You either catch the move from the start or you let it go. And the irony is, most of the moves you miss wouldn't have worked out anyway. The chart might look perfect in hindsight, but live trading isn't hindsight. Prices whip, fake, and trap. The moves that look smooth after the fact usually weren't so smooth in real time. Missing them spares you the frustration of being whipsawed by volatility that wasn't visible on the final chart. Precision comes from selective participation. You're not trying to be in every trade, you're trying to be in the right ones. When you learn to wait for your pitch, you stop swinging at everything that moves. You realize that your real power lies not in the trades you take, but in the ones you reject. That's where discipline grows, and where accuracy sharpens. Missing a move doesn't make you less of a trader. It makes you a trader with control. It means you're not ruled by emotion, not swayed by headlines, not pulled by the crowd's excitement. You're calm enough to watch opportunity pass, knowing that the market's next wave is already forming somewhere else. Defense protects capital. Accuracy multiplies it. That's the foundation of every great trader's philosophy. You can't make money in the market until you learn how not to lose it. The problem with most traders is they start in reverse. They chase profits before they understand protection. They think the secret lies in finding the next big move or the perfect entry, when in truth, it begins with the discipline to defend what you already have. Capital is your ammunition. Once it's gone, your accuracy doesn't matter because you're out of the game. Every trader loves to talk about winning, but the real professionals talk about survival. The market isn't a playground, it's a battlefield. You can't fire at every target. You have to preserve your ammo for the high probability shots. Defense is what keeps you alive long enough to take those shots. And when you do, accuracy is what turns survival into success. That's the balance one without the other collapses. Let me ask you something. Have you ever had a great streak of winning trades, only to lose it all on one careless mistake? That's what happens when defense is ignored. You can be right 9 times out of 10, but if the 10th loss wipes out the previous 9, you've learned nothing. Defense means you never let one bad trade ruin your week, your month, or your mindset. It means your losses are always within your control, never outside it. That control is your armor in this game. Defense isn't about fear, it's about respect for the market, respect for risk, and respect for the fact that no one, no matter how skilled, can predict every move. Every time you put a stop loss in place, every time you size your position correctly, every time you walk away from a trade that doesn't meet your rules, you're playing defense. And that defense builds the foundation that allows your accuracy to work when the right opportunity appears. Accuracy, on the other hand, is your offense. It's what multiplies your capital once your defense has kept it safe. But accuracy doesn't come from guessing right, it comes from choosing wisely. You wait for the market to line up with your conditions. You confirm direction through price action, volume, and behavior. You don't shoot at shadows, you wait for the target to step into the light. That's the trader's discipline, protecting capital while preparing to deploy it precisely. You see, there's a rhythm between defense and accuracy. Defense keeps you steady when the market's uncertain, and accuracy lets you strike when the picture becomes clear. You can't have one without the other. A trader with only defense never grows, he just survives. A trader with only accuracy gets reckless and burns out. The great ones master both. They guard their capital like misers and deploy it like marksmen. Do you remember the earlier video about the rule that prevents losses? That rule was all about defense, about making sure you never dig yourself into a hole so deep you can't climb out. What we're talking about now is the next step, learning how to build once you've protected. It's the same principle, extended. Defense keeps you in the game. Accuracy makes the game worth playing. You can think of trading like a two-stage engine. The first stage, defense, gets you off the ground. It's the fuel of discipline, risk control, and emotional restraint. The second stage, accuracy, propels you forward. It's the precision of your entries, the clarity of your timing, and the patience to let profits develop. Without the first stage, the second never ignites. Without the second, you never reach orbit. Most traders get this balance wrong. You know, every trader out there is looking for that one edge, that one small twist in the game that makes the difference between a losing hand and a winning one. And today, I'm going to talk about something that sounds simple, maybe even too simple, but it's the kind of simplicity that took me years to understand. This talk builds naturally on what we discussed in the previous video on rule that prevents losses, because before you can make your trades more accurate, you first have to make sure you're not bleeding capital through carelessness. Now, here's the truth. There isn't any trick in Wall Street that can beat patience, discipline, and observation. But there is a simple trick to improve your trading accuracy, one that separates the guessers from the professionals. It's not about fancy indicators or complex algorithms. It's about learning to sit still until the tape shows its hand. I don't mean sitting idle out of fear. I mean waiting because you've read the market's tone and you're letting it confirm your judgment. Tell me, have you ever jumped into a trade just because you felt the move coming, only to watch it reverse the moment you press the button? Every trader's done it. That's human nature. We want action. But the market doesn't reward excitement, it rewards clarity. And clarity comes from preparation. When I say simple trick, I mean developing the habit of confirming your idea through price behavior, not your emotions, not your gut, not the headlines. The tape never lies. You can lie to yourself all you want, but that ticker will always tell you the truth if you know how to listen. You might think it's going up because the news looks good or because a friend says it's a sure thing. But if the price action doesn't agree, you're already on the wrong side of the trade. You see, the key to accuracy is alignment, the alignment between your reading of the market and the actual behavior of prices. Before I ever took a position, I waited for the market to confirm my thinking. The amateur guesses, the professional waits. That's the trick. You let the market show its strength before you risk a single dollar. Now, here's something most traders overlook. Accuracy isn't about being right more often. It's about losing less when you're wrong. Think about that. A trader can be wrong half the time and still grow rich if he controls his losses and lets his winners run. So when I say improve your accuracy, I don't mean chase perfection. I mean learn to eliminate the poor trades before they happen. Accuracy is selective participation, picking only the spots where the odds favor you. Do you remember the feeling of watching a stock climb without you wishing you'd bought earlier? That's greed whispering in your ear. But a real trader knows that missing a move is cheaper than forcing a bad one. You want accuracy, then stop needing to be in every trade. The market's always there tomorrow. Let's connect this back to what I said in that earlier talk, the rule that prevents losses. That rule was about protecting your stake, because survival comes before profit. What we're discussing today builds right on top of that. Improving accuracy means you take fewer shots, but each one cleaner, clearer, better aligned with the market's rhythm. You're no longer gambling, you're acting with precision. Most traders don't fail because they lack information. They fail because they act too soon or too often. They want the market to confirm them, instead of the other way around. But a trader's job isn't to predict, it's to react correctly. When you stop needing to prove yourself right and start letting the market prove itself, your accuracy shoots up almost overnight. Here's another question for you. Do you track your trades? Really track them. Not just the profits, but the patterns, the setups, the times you felt impatient. Because if you don't, you're flying blind. A trader's logbook is worth more than any signal service you'll ever subscribe to. I used to write down every trade, what I saw, what I thought, what the market did afterward. Over time, I started seeing patterns not just in the tape, but in myself. That's when accuracy began to sharpen. You have to know your own weaknesses as clearly as you know your charts. Maybe you trade best in trends and poorly in choppy markets. Maybe you lose focus after 2 trades. Maybe you chase when you're bored. Those details, those are your real trading indicators. The market doesn't change much, the players do. So your biggest trick is to know your own game better than the market knows you. Now, don't mistake this for overanalysis. You can't let hesitation paralyze you. When the setup matches your plan, and the price confirms your direction, then you act, no hesitation, no second guessing. The simple trick isn't about doing more thinking, it's about doing the right waiting. Some traders ask me, Jesse, how do you know when the price is right? I tell them, you don't guess, you watch for behavior. Watch how the stock reacts after a breakout. See if it holds its gains or slips back under resistance. Watch how it trades when the market turns soft. Strong stocks act strong. Weak stocks crumble. That's all the confirmation you need. And here's a secret: most of your accuracy comes from staying out of the market. That's the part no one likes to hear. The biggest profits are made in the sitting, not the trading. The simple trick is the art of waiting for your pitch. The market's job is to throw distractions at you: rumors, spikes, reversals. But your job is to stand there, watch them pass, and only swing when the odds are stacked in your favor. You'll find, over time, that the fewer decisions you make, the better they become. Trading isn't about constant action, it's about selective precision. You don't measure success by how many trades you make, you measure it by how many you avoid until the right one comes along. And if you remember the principle from that earlier video, the rule that prevents losses, you'll see how it ties perfectly here. That rule was your defense. This one is your aim. Defense keeps you in the game, accuracy takes you forward. One without the other is useless. So, before you place your next order, ask yourself, has the market confirmed my idea? Or am I just hoping it will? Because hope is the costliest emotion in this business. The moment you stop hoping and start waiting, you begin to trade like a professional. Every great move I ever made came after the market told me it was time, never before. Accuracy means losing small, not being right always. Most traders never understand that, and that's why they fail. They believe trading is about prediction, about calling tops and bottoms, about proving how smart they are. But the market doesn't care how often you're right. It only cares about how much you lose when you're wrong, and how much you make when you're right. That's the difference between amateurs and professionals. The amateurs chase perfection, the professionals chase survival. Now, let me ask you something. How many times have you had a trade that was wrong, but you refused to admit it until it became painful? Everyone's done it. You tell yourself it'll come back, that it's just a shakeout, that you'll give it one more day. That's not trading, that's hoping. And hope is poison in this business. The market doesn't punish you for being wrong. It punishes you for staying wrong. The whole secret of accuracy is knowing when to cut. When I was trading in my early days, I wanted to be right on every position. It bruised my pride to take a loss. I'd add to losers, double down, tell myself I knew better than the market. That arrogance cost me fortunes. It took years and several hard lessons before I realized that accuracy isn't measured by the number of correct predictions. It's measured by how well you control damage when you're wrong. You can make mistakes all week and still end up profitable if your losses are small and your winners are allowed to breathe. A trader who wins 40% of the time but cuts losses quickly will outperform the trader who wins 80% of the time but refuses to take a small hit. Why? Because the first trader plays defense like a hawk. He understands that trading is a game of capital preservation first and profit second. He doesn't waste time defending a bad trade. He steps aside, studies the tape again, and waits for the next high probability setup. That's real accuracy. It's the discipline to be wrong the right way. You might think, but Jesse, if I cut every trade that moves against me, won't I get shaken out too often? Maybe. But that's a small price to pay compared to getting buried in one trade that goes terribly wrong. The market will always offer you another chance, but it won't always offer you another bankroll. You can't control whether the next tick goes your way, but you can control your exit. And control is what keeps you alive in this game. There's a strange comfort in realizing you don't need to be right most of the time. It frees you from the pressure that ruins judgment. You stop trying to predict and start reacting. You start focusing on what the market is doing, not what you want it to do. Accuracy improves the moment ego steps out of the way. Tell me, do you know what happens when you stop defending wrong trades? You start seeing clearly. Your charts make more sense. Your analysis sharpens. Because you're no longer emotionally attached to your positions. The worst trades are the ones you fall in love with, the ones you can't let go of because you've convinced yourself they have to work. But nothing in the market has to happen. Prices don't owe you a return to break even. They just move, and if you don't move with them, you get left behind. That's why cutting losses quickly is not weakness. It's accuracy in motion. It's your way of aligning with the market instead of fighting it. Every time you cut a losing trade, you're making room for the next opportunity. You're staying liquid, mentally and financially. Liquidity is a trader's lifeblood. Lose it, and you're stuck watching, hoping, paralyzed. And remember what we talked about in that earlier video on the rule that prevents losses. That rule was about defending your capital, about staying alive long enough to play the next hand. What we're saying here builds right on that foundation. Losing small is the natural extension of that rule. You can't prevent losses completely, but you can make them manageable. You can make them part of your plan instead of part of your downfall. Most traders treat losses as failure. Professionals treat them as expenses. Every business has costs. Trading is no different. Your stop loss is the rent you pay to stay in business. You can't run a shop without paying rent, and you can't trade without taking losses. The trick is to keep that rent low enough so it doesn't eat your profits. Once you accept that, accuracy becomes less about prediction and more about precision. Precision means you don't waste bullets. You don't scatter your trades everywhere. You pick your shots carefully, and when they miss, you move on without hesitation. That's how you stay consistent. That's how you develop the confidence that separates the professional from the crowd. Because confidence in trading doesn't come from winning. It comes from knowing you can handle losing. Ask yourself this: would you feel comfortable taking 10 small losses in a row if it meant the 11th trade would wipe them all out and more? That's the test. Most traders wouldn't. They'd get emotional after the third loss, change their system after the fifth, or give up before the next opportunity. But the professional expects those small losses. They're part of his process. They don't shake him because he knows the math behind his edge. Accuracy to him is consistency in execution, not perfection in prediction. And when you trade that way, something powerful happens. Your emotions settle. You stop chasing revenge trades. You stop increasing position size to make back a loss. You stop needing the market to prove you right. Instead, you follow your plan. You take your small losses like a surgeon, clean, quick, and without regret. You let your winners run with calm confidence. Over time, your equity curve stops looking like a roller coaster and starts looking like a steady climb. That's the truth about trading accuracy. It's not a game of being right more often. It's a game of managing being wrong intelligently. The trader who masters that never fears the market again, because he knows exactly how much he's willing to lose long before he enters a trade. Trade less, but trade with precision. That's a lesson every trader learns the hard way, and usually after the market has taken its toll on their capital. You see, the instinct of most traders is to always be doing something, always buying, always selling, always reacting. They confuse activity with progress. But trading isn't about how many times you act. It's about how well you act when the time is right. The market doesn't pay you for movement. It pays you for timing. When I was young, I thought success came from being in the market every day. I believed the more trades I took, the closer I was to catching the big move. But I learned that the more I traded, the more mistakes I made. The market has a rhythm, And if you trade too often, you lose the ability to hear it. It's like trying to listen to a whisper in a storm, too much noise, too much excitement, too little clarity. Precision comes from calm observation, not constant action. Let me ask you something. How many trades have you taken out of boredom? You look at the screen, you see nothing special, but you still want to do something. Maybe you tell yourself it's just a small position, just to stay in the game. That's not discipline. That's restlessness disguised as strategy. Every unnecessary trade you make dulls your judgment. The best traders aren't those who act the most, they're the ones who wait the longest for the right setup and then strike without hesitation. Trading less doesn't mean you're lazy or scared. It means you respect the market enough to know when it's not offering an edge. Most of the time, the market is in noise mode, too many cross currents, too little direction. Professionals sit it out during those phases. They don't mind waiting because they understand that patience is a position, too. The amateurs, on the other hand, feel the need to prove something every day.